Hey everyone, and welcome back to The Explainer. Today, we've got an absolutely fascinating deep dive lined up for you. We are going to conduct a full medical autopsy, basically a top-to-bottom diagnostic screening on India's absolute largest pathology company, Dr. Lal PathLabs. You know, if you've ever wondered how a seemingly simple diagnostic business can transform into a massive compounding machine, well, you are exactly in the right place. Welcome to Stress-Free Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, let's quickly run through the agenda for today's checkup. Section 1. Inside the hub and spoke moat. Section 2, financial health and vital signs. Section 3, stress testing the red flags. Section 4, valuation, pricing the compounder. And finally, Section 5, the final investment verdict. Okay, moving right into part 1, inside the hub and spoke moat. Let's start by examining the core anatomy of Dr. Lal PathLabs. What actually gives them a real defensible edge in a highly unorganized sector? Look, we aren't talking about some cash-burning startup here. This is a 75-year-old brand. When a patient needs a complex test or when a doctor writes a prescription, they literally write Dr. Lal by name. That kind of switching cost moat is built entirely on generational patient trust. And to put it into perspective, they are processing an astounding 94.5 million samples every single year. Their scale is just unmatched in the Indian market. Their setup perfectly illustrates their operational genius. They have exactly one national reference lab in Delhi for the super complex esoteric tests, which is supported by just a few regional hubs. But then, as you move down the funnel, it scales out massively to almost 14,000 pickup points across the country. The real secret? That huge collection network is mostly franchisee run. So they get this massive asset-light funnel for sample collection, but they keep tight, centralized control over the high-complexity, high-margin testing. It really is a beautiful machine. And notice how 27% of their revenue is now coming from those SwasthFit wellness packages. Guys, this is a total structural masterstroke. In a world where your basic standalone tests are becoming completely commoditized and everyone's fighting price wars, preventative health bundles lock in sticky, repeating customers. These are folks testing annually, and they aren't going to shop around just to save a few bucks on a single blood test. It completely insulates them from that cheap B2C competition. Moving on to Section 2. Financial health and vital signs. Let's draw some financial blood work, shall we, and check the vitals on this compounder. Boom, an exceptional 44% return on capital employed, excluding cash. I mean, this proves that their franchised hub and spoke model works exactly as intended. They can grow geographically, adding thousands of collection centers without constantly needing massive capital injections. Their capital employed has basically stayed flat over the last 4 years, while earnings just keep growing. That right there is the ultimate hallmark of a world-class compounder. What's really interesting here is their absolute fortress of a balance sheet. They are sitting on over 1,500 crores in net cash, which is roughly 6% of their entire market cap. And they have absolutely zero financial debt, none. Plus, they generate around 500 crores in free cash flow every single year. That is the kind of financial stability that lets management sleep very soundly at night. But wait, here is where it gets even better. They operate on negative 26 days of working capital. So what does that actually mean for us? It means patients pay upfront. They pay in cash or by card the second they give their sample. Meanwhile, the company turns around and pays its reagent suppliers on a 30 to 60-day credit cycle. They are literally self-funding their own growth using their suppliers' money. It's incredible. And when we run our quantitative health screens, they get a completely clean bill of health. They have a strong Piotrowski score for fundamental strength, an Altman Z-score that puts them massively in the safe zone against any bankruptcy risk, and crucially, a negative Benish M-score. That last one is huge. It tells us there's no accounting manipulation going on. It's just clean, hard cash. In fact, their actual cash flow generated from operations significantly exceeds their reported profits. All right, Section 3, stress testing the red flags. Because, look, no medical checkup is complete without screening for risks, right? We have to ask ourselves, despite these pristine financials, what are the systemic shocks or market forces that can actually derail this compounding machine going forward?
Impartially speaking, looking at the data, the biggest red flag for the sector is potential government price caps. Historically, the government has stepped in occasionally to cap diagnostic test prices, and obviously that would squeeze margins. Closely following that is the heavy discount competition from online aggregators, think 1mg and Pharmacy, who are aggressively fighting for those bottom-tier commodity tests. And finally, there's a transition risk right now with a newly appointed CEO taking the reins from the founding family.
However, kind of offsetting some of those risks, we've recently seen strict value quality funds, like the Pareg FlexiCap Fund, initiate positions here. For a fund that is famously known to heavily scrutinize valuations and business durability, this is a very notable smart money signal. It indicates that top-tier institutional investors are looking past the short-term noise and seeing serious long-term durability in the business model.
Section 4. Valuation. Pricing the compounder.
Let's move to the prognosis phase. How is the market actually pricing all this fundamental quality? Because, as we know, a great company is only a great investment at the right price. Even though Lal PathLabs is the largest player in the country, with the highest return on equity and capital, they are currently trading at a noticeable discount to their listed peers. At a PE of roughly 52, they are cheaper than Metropolis at nearly 60 and Vijaya at up to 69. That arguably makes them the cheapest among the premium diagnostic chains while still offering the best underlying fundamentals.
Laying out the scenarios purely based on the research note, we're looking at a pretty asymmetric risk-reward profile here. The base case targets 1,800 rupees over the next 18 to 24 months, and that assumes management simply hits their own conservative guidance of 13 to 15% revenue growth. But if the market starts to re-rate them higher based on their AI integration and scaling up genomics, we could easily see a bull case hitting 2,250 rupees.
Finally, Section 5, the final investment verdict. Bringing all of this data together, what is our final diagnosis? Well, the recent short-term stock underperformance was mainly dragged down by a post-COVID hangover and a one-time 30-core labor code cost that definitely suppressed recent quarterly earnings. But looking ahead on their timeline, the forward catalysts point toward highly predictable double-digit growth. Management is confidently guiding for that 13 to 15% growth, and by FY28, their new AI recommendation tools and genomics platforms should be scaling up beautifully. So, the crucial takeaway here, this company scores a massive 77 out of 100 on the stress-free investing framework. That lands it solidly at an A grade. It is a high-quality compounder that definitely warrants patient accumulation. The strategy laid out in the research is super clear. Buy on dips. If you can pick this up during market corrections, you are buying a premier asset at a serious discount. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which India-listed companies should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.